Welcome back to Investing Talk Podcast.
Today we're looking at Bloom Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. All right, let's just get right into it, because today we are looking at what might honestly be the single most critical bottleneck in the entire technology sector right now.
Yeah, it's the physical limit of this whole AI boom.
Exactly. I mean, everyone you talk to, they are hyper-focused on artificial intelligence. The market is completely obsessed with the new language models, the incredible processing power required to train them, and the sheer volume of data being generated every single millisecond. But there is this looming foundational problem that I think the broader market is only just starting to fully appreciate. AI data centers are consuming an absolutely astronomical amount of electricity.
Unprecedented. We're talking about power requirements that are just completely unprecedented in human history.
Right, and frankly, the traditional legacy power grid simply cannot handle the load.
It can't. And that is exactly the bottleneck we're facing. And it is a physical limitation, not some software issue that you can just patch. You have these hyperscalers.
The trillion-dollar tech giants.
All right, the absolute giants of the tech world. And they are aggressively building out this massive AI infrastructure, but they're hitting a brick wall. They can buy all the advanced graphics process units they want, but if they cannot plug those sprawling data centers into a reliable, enormous power source, the whole AI revolution effectively grinds to a halt. The traditional electrical grid is aging, it is heavily overtaxed, and upgrading it is not a quick fix.
No, not at all. You're talking about years of red tape.
Decades sometimes. You have regulatory approvals, environmental impact studies, heavy infrastructure builds just to lay down new transmission lines. And that is where Bloom Energy enters the picture. They offer this bring-your-own-power solution.
Yeah.
Instead of waiting for the local utility company to run new lines to a remote data center, Bloom essentially allows these tech companies to drop a highly efficient commercial-scale power plant right in their own backyard.
So what does this all mean for you, the listener? Because today we are asking the hard questions. Is this company the premier backdoor play for the AI boom? Is it the ultimate picks and shovels investment for the artificial intelligence gold rush? Or, when you look at some of these eye-watering valuation metrics, is it just a hype-driven bubble waiting to burst? We are going to look at the cold, hard fundamentals, the technical price action, the market sentiment, and we are going to take a hard look beneath the hood at the very real risks involved.
It is a fascinating setup because you have this rare collision of legacy industrial manufacturing with cutting-edge AI momentum. Now, really understand the thesis here, we have to start with the fundamental trajectory of the business, because the numbers coming out of their recent reports are nothing short of historic for them.
Let's transition smoothly into those fundamental numbers then, because a compelling narrative is great, but as the skeptic here, I want to look at the reality of their balance sheet and their earnings. Those data centers need juice, yes, but are they actually monetizing this AI power demand?
They absolutely are. And I am thrilled to break down this revenue and earnings trajectory because the 2025 numbers are just spectacular. Bloom Energy just reported a record full-year 2025 revenue of $2.02 billion.
$2.002 billion.
Exactly. That is an increase of 37.3% from the $1.47 billion they posted back in 2024. And you have to understand the context here. This isn't a software company just selling more digital licenses where the cost of replication is zero.
Right, this is heavy hardware.
This is physical infrastructure. Growing top-line revenue by over 37% in heavy hardware is a staggering achievement. It is being driven directly by surging demand from the AI data center industry and their commercial customers. And if you look at their fourth quarter of 2025 specifically, it was a phenomenal beat. They generated $777.68 million in revenue for the quarter alone, with an earnings per share of 45 cents.
And the consensus was what, 25 cents?
Yes, the market consensus was expecting only 25 cents EPS. They absolutely crushed the estimates.
Look, the 2025 numbers are undeniably impressive, I will give you that. But what really caught my eye as the data checker in the room is the forward guidance for the full year 2026. Because the market is a forward-looking mechanism. It doesn't care what you did yesterday, it cares what you're going to do tomorrow.
Exactly, and the sheer scale of that forward guidance is what has Wall Street scrambling right now. Management is officially projecting 2026 revenue to come in between $3.1 and $3.3 billion.
Which is a massive jump.
It is. The consensus on the street was hovering around only $2.3 billion. So management is implying an incredible top-line growth rate of roughly 60% year over year. Furthermore, they're guiding for an EPS of $1.33 to $1.48, which utterly dwarfs the previous 70-cent consensus. This implies management is fully expecting these AI tailwinds to accelerate violently over the next 12 to 18 months.
Okay, those growth numbers are stellar on paper, but we need to examine the financial health and the underlying stability of the business. Because whenever you see a hardware-intensive company guiding for 60% growth, you have to ask how they are paying to scale up that fast. Looking at the metrics, there is some real volatility here that you, as an investor, need to be aware of. They carry a very high beta of 3.07.
It's definitely on the higher end for industrials.
It's massive. For you listening, beta measures volatility against the broader market, which is always set at a flat 1.0. So at 3.07, if the S&P 500 takes a small step up or down, this stock is taking a triple-sized leap. For better or worse, it is incredibly reactive. But I will concede a very positive milestone here. In 2025, Bloom finally achieved break-in and full-year profits for the first time. They are showing improving net margins, currently sitting at 0.84%, and a return on equity of 8.74%.
And achieving that break-in profitability is a crucial inflection point. It changes the entire narrative for the business. Because they are now generating positive full-year profits, they are taking that capital and aggressively reinvesting it straight back into their AI data center expansion.
Right. You aren't seeing them issue dividends to shareholders.
No dividends, and they aren't executing share buybacks either. They recognize they have a once-in-a-generation opportunity to capture market share, and they are funneling every available dollar into scaling their manufacturing operations to meet this 60% growth target.
Which brings us to the actual product. Because to justify those aggressive reinvestments, they need a serious competitive moat. What is actually stopping the hyperscalers from just buying power solutions from someone else?
The competitive moat is arguably the strongest part of the long-term thesis here. It centers around the proprietary technology called the Bloom Box. This is a solid oxide fuel cell platform. To explain that simply, it is an electrochemical process. There is no combustion.
So it's not a generator in the traditional sense.
Exactly. Think of it more like a battery that never needs recharging, so long as you continually feed it fuel. It takes a fuel source, mixes it with air, and directly converts it into electricity with incredible efficiency. It is entirely IP protected, meaning competitors cannot simply reverse engineer it legally. It is highly reliable, and crucially, it is hydrogen agnostic.
Explain why that hydrogen agnostic part is so important for these tech companies.
Because it future-proofs their entire multi-billion-dollar investment. The Bloom Box can run on widely available natural gas today, but it is entirely ready to transition to pure hydrogen or biogas as those clean energy infrastructures mature over the next decade.
So they don't have to rebuild the facility later.
Precisely. This creates enormous switching costs. Once a tech giant installs a Bloom Box array to power a massive AI data center, they are locked into that ecosystem. They aren't going to rip out that foundational infrastructure to save a few pennies with a competitor like Plug Power or Ballard Power. Bloom is offering scalable, highly reliable power tailored exactly for hyperscalers who cannot afford a single millisecond of downtime.
But having a world-class product doesn't always equal a great stock. Let's pivot to the charts to see how the market is actually pricing in all this growth. Because you can have the best solid oxide fuel cell in the world, but if institutional buyers aren't stepping up, it doesn't help your portfolio.
The price action recently has been a wild ride, to say the least.
It really has. Let's unpack the post-earnings reaction from February 5, 2026. On the back of those record results and that 60% growth guidance we just talked about, the stock popped aggressively. It hit $140.40 intraday. You could see the momentum trying to push back up toward the 52-week high, which currently sits at $176.49. But as we often see with highly volatile, high-beta names, that initial euphoria was met with a harsh reality check. We saw an immediate sell-the-news pullback, dragging the price back down to $136.0.
That sell-the-news reaction is incredibly common, especially in this sector. When a stock has already run up significantly into an earnings print, large funds will often take their profits off the table the moment the good news hits, regardless of how strong the forward guidance actually is.
They luck in the gains.
Right. But if you zoom out and look at the broader trend, the technical structures are actually exceptionally healthy. The 50-day simple moving average is sitting at $117.11, and the 200-day moving average is down at $91.27.
And for context for our listeners, when your 50-day moving average is that far above your 200-day and the current stock price is well above both of those lines, it proves the broader macro uptrend is fully intact. The stock is consistently making higher highs and higher lows on the daily chart.
Exactly. And the volume is what really confirmed the trend for me. On that earnings day, we saw an explosive 13.3 million shares traded. To put that in context, the average daily volume is around 12.9 million.
That's a huge spike.
It's massive. That kind of sustained heavy volume on an earnings beat isn't just retail day traders flipping the stock on their phones. That is serious institutional accumulation. That is large mutual funds and pensions taking substantial long-term positions based on the new 2026 guidance.
And the analysts are clearly following that institutional flow. We've seen a flurry of recent analyst price target hikes. One of the notable recent upgrades pushed the price target up to $146.42, which represents a 16.43% increase from recent levels. That implies significant breakout potential. If they can chew through that stubborn resistance level right around $140, technically speaking, there isn't much overhead supply stopping a run back toward those 52-week highs.
Chart levels are great, but the story drives the multiple. Moving from the charts to the chatter, let's look at what the street is actually saying, because the narrative surrounding a stock often dictates its valuation just as much as the raw math does. And the news cycle right now is incredibly thematic.
You are seeing a real tug of war in the financial media. On one hand, you have incredibly bullish headlines declaring, "Bloom the bring your own power leader," clearly latching onto the AI data center narrative. But on the exact same day, you see much more cautious, skeptical headlines. Things like subtle economics when discussing the real-world costs of scaling these fuel cells, or articles warning about a priced-for-perfection valuation.
And here is where the sentiment algorithms show a fascinating disconnect. Despite the earnings beat, despite the 60% forward revenue guidance, and despite the heavy institutional volume we just discussed, the general quantitative news sentiment algorithms are still scoring the coverage as strictly neutral.
Which is surprising.
Very. And if you look at the broader analyst consensus, technically speaking, it is currently listed as a hold with an average price target of $111.
Which is wildly lagging behind reality at this point. Obviously, those newer upward revisions to $146 are starting to catch up, but the aggregate consensus is still dragging its feet behind management's new guidance.
That lag is exactly what creates the opportunity for an observant investor. But beyond the official analyst upgrades, the speculative catalysts and insider flow are where the real story is taking shape. I am looking at some of the recent rumors and commentary. The CEO recently spoke about a seismic shift occurring in the AI data center space. But the whispers that really excite the engineering crowd involve an 800-volt DC architecture.
Break that down for us. Why does 800-volt DC matter so much?
There are heavy rumors positioning Bloom Energy to deploy this 800-volt direct current setup, specifically for high-power edge computing. To understand why this is revolutionary, think of traditional alternating current power, like shipping goods on a train.
Okay, a train.
You have the train going, but at every state line, you have to stop, unpack the cargo onto a truck, drive it a bit, and then load it back onto a different train.
That sounds incredibly inefficient.
It is, and that is exactly the power lost, constantly converting DC to AC and back again for these intense AI server racks. The 800-volt DC architecture removes the trucks entirely. It is a direct, high-speed rail straight to the AI servers, minimizing power loss and generating a monumental leap in efficiency.
That is a phenomenal analogy, and I can confirm the smart money is definitely paying attention to these technological shifts. We track significant whale activity, meaning abnormally large options or equity blocks on March 3rd in the industrial sector, specifically targeting this ecosystem.
The big players are moving in.
They really are. We are seeing sustained accumulation by small-cap growth funds. For instance, Carroll Engel was notably adding to their position heavily in the fourth quarter of 2025. And crucially, insider ownership is holding perfectly stable at 3.6%. The executives inside the company aren't using this post-earnings pop as exit liquidity to dump their shares. They are holding their ground.
Which perfectly sets up the catalyst calendar for the next 3 months. You, as an investor, need to know what upcoming events are going to move this stock next. We have the Q1 2026 earnings coming up in late April or early May. The street is going to be watching like a hawk to see if they're actually tracking against that aggressive full-year guidance.
It's going to be a make-or-break quarter.
It is. But equally important are the upcoming Q2 AI and data center conferences. This is where you typically see the hyperscalers announce their new infrastructure partnerships. A major headline announcing a substantial deployment with a leading tech giant could be the fundamental catalyst that breaks the stock cleanly above that $140 resistance.
I love the optimism, I really do. But before we get too carried away with the AI hype, we need to execute a deep dive into the risks here. Because as the skeptic in the room, there are a couple of glaring red flags on this balance sheet that any rational investor has to confront before deploying hard-earned capital. First and foremost, the valuation.
I knew you were going to bring this up.
I have to. I mentioned earlier that some headlines were calling it a priced for perfection valuation, and they are completely correct. For value investors, this metric is terrifying. The current price-to-earnings ratio is sitting at an astonishing 938 times earnings.
That is a staggering PE ratio. I won't deny that.
It is beyond staggering. When you combine a PE of 938 with a beta of 3.07, it completely explains why the stock suffered that immediate sell the news drop after a tremendous earnings beat. When you are priced at nearly 1,000 times trailing earnings, a beat isn't just hoped for, it is demanded. Perfection is literally baked into the share price.
The expectations are sky high.
Exactly. If they miss a single quarterly execution target, the multiple compression could be violent, and it will be retail investors left holding the bag.
I hear that, but I have to counter that argument. A trailing PE ratio is looking in the rearview mirror. You have to contextualize that valuation against the forward guidance. Yes, 938 times trailing earnings is sky high, but that valuation becomes entirely manageable if, and it is management's explicit target, they execute on that 60% revenue growth.
That's a massive if, though.
It is, but when you grow the top line from $2 billion to $3.3 billion in a single year, that earnings multiple contracts incredibly fast. You are paying a premium today for what the company will realistically be earning in 2026 and 2027.
I hear your point on forward growth, but banking on a 60% revenue leap in heavy hardware manufacturing is tough. If they suffer even a slight supply chain hiccup, or if raw material costs spike, that 938 multiple will crush investors. How bulletproof is this guidance, really? Which brings me to my second major concern, the debt load.
The debt is necessary for scale.
But it's heavy. To achieve that kind of rapid scale, you need heavy capital expenditures. Bloom currently has a debt-to-equity ratio of 1.98. They are carrying roughly twice as much debt as they have equity on the books. In a capital-intensive manufacturing environment, high leverage leaves you highly vulnerable to any macroeconomic shocks.
The leverage is a known factor, but again, the context of their liquidity completely changes the risk profile here. If you look at their current assets versus their short-term liabilities, they have a current ratio of 4.40.
Explain what that means for the listeners who might not track liquidity ratios.
Basically, it means that for every dollar of debt due over the next 12 months, they have $4.40 in assets ready to cover it. That is incredibly robust. And even if you strip out their inventory, which obviously takes time to sell, and just look at their most liquid assets, they have a quick ratio of 2.88.
So they are highly liquid.
Highly. That means they can pay off their immediate liabilities almost 3 times over tomorrow if they absolutely had to. When you pair that fortress of short-term liquidity with the predictable recurring cash flow driven by this AI demand, that debt load isn't just manageable. It is an intelligent use of leverage that is already priced into the risk models of every major institution holding the stock.
All right, you've made a compelling case on the liquidity side. So what does this all mean for you, the investor? We have covered a lot of ground today. Let's get to the final verdict. We've looked at the remarkable revenue growth, the solid technical uptrend, the neutral but improving sentiment, and we've heavily debated the very real risks of a high valuation and heavy debt load.
Synthesizing all of those data points, the fundamentals, the technicals, the sentiment, and the risk profile, our analysis results in a definitive bullish score of 9 out of 10.
A 9 out of 10 is an exceptionally strong conviction rating. Let's distill this down to the ultimate elevator pitch for the listener.
The core thesis here is a story of necessary transition. Bloom Energy is rapidly transforming from a $2.02 billion company into a guided $3.3 billion powerhouse. That leap makes it the undisputed premier on-site power provider for an AI data center market that is absolutely exploding right now. The tech giants simply cannot wait for the traditional grid to catch up to their power demands. Bloom's proprietary Bloombox technology, their highly efficient hydrogen-agnostic fuel cells, has erected a durable competitive moat that rivals like Plug Power and Ballard simply cannot easily cross.
And the target horizon here isn't a quick day trade. Given the institutional accumulation and the sheer scale of the 2026 guidance milestones, the thesis dictates that this is a multi-year hold into 2026. You are waiting for those bold revenue targets to be realized, allowing the valuation multiple to compress naturally while the stock price appreciates.
Exactly. It is about letting the fundamental earnings catch up to the current premium while the technological moat continues to deepen.
I want to leave you with a final, provocative thought to chew on. We have established that AI data centers are growing exponentially faster than the physical legacy electrical grid can possibly expand. Given that stark reality won't bring your own power, eventually transition from being a luxury alternative for these hyperscalers into an absolute mandatory requirement for all tech giants. If the public grid cannot power the future, the private companies that can will dictate the terms of the next decade of technology. Subscribe, like, and comment to support the Investing Talk podcast.